Okay, good morning. Good morning, everybody. Thank you for joining me on this beautiful day. And we're going to get started soon. I see that there are more people entering the room. So I'm just going to give it a few more seconds, let the room fill up, and then we will dive into the material. Just a few more seconds. Let's let people enter. All right. All right. I see more people entering the room. Fantastic. Fantastic. All right. Excellent. Excellent. Thank you, everybody. All righty. Welcome, everybody. Good morning. Good morning. Good morning. I'm grateful for everybody attending this class. We got some juicy information to share with you guys. Today's material we're going to get into is the best times to retire. Believe it or not, sometimes one day, 1 week, 1 month can make a big difference in your decision to retire and the amount of benefits and the amount of pension you get and the amount of annual leave you walk away with. So I'm excited to share the information with you. But before I dive into the material, before I dive into the information, the first thing I want to do is I want to point out, like I usually do on my webinars, that these webinars don't happen in a vacuum. These webinars happen because there are people who are encouraging me, supporting me to do this. Those are my clients. Those are my members. So if you guys know somebody who's a client or a member of mine, go over to them and give them a hug and a thank you. Okay. And also, if anybody here is interested in becoming a client or a member of mine, one of the things you could do to become a client or member, well, I guess the first thing you could do is reach out to me and schedule a meeting so we can get together. I just posted something on the side. I'm not sure if you guys can see that. On the right-hand side, you'll see a picture with a button. And if anybody here is interested in getting together, what you should do is you should click on that button and request a complimentary one-on-one get-together. And I'd be happy to get together and talk to you about your financial needs and if I could help you in any way. Fantastic, fantastic. All righty, everybody. So let's dive into the material of the best times to retire. Now, I'm sure you guys have already thought about the age that you want to retire. So whether it is minimum retirement age, so whether you're a CSRS person, your minimum age is 55, or if you're a first person, your minimum age is going to be 56. For most of you, it's probably going to be 57 for the first people. So some of you may have already defined which age you're going to retire. So whether it's going to be minimum retirement age, or let's say age 62, because that's when you can start getting Social Security, or maybe you want to wait till a later age when you get the full Social Security. Whatever it may be, whatever age it is, we have to then investigate. When you reach that age, when in that year should you retire? Should you retire at the beginning of that year? Should you retire at the end of that year? Does it even make a difference? So believe it or not, I can give you some arguments to retire either towards the end of the year or towards the beginning of the year. So let's go through the details over here. And by the way, I warn you, some of the material we're going to cover today is very technical, super technical. However, if you follow my thinking, you may find that it's in the technicalities that you can make some good money. And sometimes you'll see that there are different angles that are sometimes delicious to understand that it made such a big difference. Okay, so let's give the arguments to retire towards the end of the year. Let's start with those. Now, I have two arguments, and I admit the first argument is a weak argument. It's going to sound very impressive at first, but it's really not that impressive. What is the first argument to retire towards the end of the year? It's the jump start on the COLAs. Now, federal retirees, if you're a first person age 62 and above, you're going to get a COLA. If you're a CSRS person, you'll get a COLA right away. But federal retirees are scheduled to get a COLA. COLA stands for cost of living adjustment. It's basically an inflation adjustment to your pension. Now, I don't know if anybody here is aware, when in the year does that inflation adjustment get reflected in your pension pay? Meaning, when in the year does your pension go up to reflect that inflation adjustment? So for those who don't know, it happens in January. The pension check that you receive in January will have the inflation adjustment. But here's the thing. In order to get that increase, that inflation adjustment in your January check, you have to be able to receive a pension check in January. And in order to receive your pension check in January, you have to be deemed retired in December. Now, we will learn very, very soon that in order to be deemed retired in December, if you're a first person, you cannot work even one day in December. Because if you dare work even one day in December, you're not deemed retired in December. And then you won't get a pension check in January. So let's illustrate this. Let's say a person decides that they're going to retire not in December. They want to retire at the end of November. If they retire at the end of November, they will be deemed retired in December. And then they'll get a pension check in January. So one person decides they're going to retire at the end of November. This way they are deemed retired in December, and this way they get a pension check in January. There's another person who says, nah, I'm not going to do the end of November. Instead, I'm going to do the end of December. Watch carefully what happened with those two. The one who retired at the end of November, they were deemed retired in December, and so they're going to get a pension check in January. And already in January, that's when they will receive their COLA. Their pension will already be adjusted to reflect inflation. What about the person who retired at the end of December? When do they receive their COLA? Now, you may think that they'll receive their COLA in February. Nope, they're not going to receive their COLA in February. The one who retires at the end of December, they're not going to receive their COLA in February. They're going to receive their COLA the following January. The following January. That means the person who retired at the end of November actually got a jump start on the COLAs. And the person who retires in December, they missed the COLA and they have to wait an entire year until their COLA kicks in. Now, when I mention this in my classes, I see people's jaws drop. They're like, what? That's crazy. No way. Now, I know it sounds impressive, but the truth is, it's really not a big deal. It's not that impressive. And I'll explain to you why. Because you'll get the COLA in January, but will you get the full COLA in January? The only way you can get a full COLA in January, the full measure of inflation, the only way you'll get that full COLA in January is if you were retired for the full previous year. If you were retired for the previous year, the entire previous year, then you'll get the full COLA in January. But if you were only retired for part of the previous year, then you'll only get a partial COLA in January. It's going to be prorated. So if you think about it, the person who retired at the end of November, how many months of the previous year were they retired? So if they retired at the end of November, they were deemed retired in December. So that's really, they were only 1 month retired in the previous year. And then when the COLAs kick in the next year, they're going to get a COLA, but it's not going to be the full COLA. It's only going to be a partial COLA. In fact, the math is, it's only going to be 1 month or 1/12 of whatever the full COLA would have been. Now, when you start looking in those terms, 1/12 of the COLA is really not that impressive, especially if you were thinking to work to the end of December. You're right. If you'd work to the end of December, you're right. You wouldn't get the 1/12 of the COLA. You know what you would have gotten? You would have gotten the entire month of December's pay, and then you would have gotten the month of December added to your pension. And if you think about it, if you add December to your pension, for those who don't know the way the calculation works, especially in the first system, it's easier to explain. The CSR is a little bit more challenging. But in the first system, every year that you work is worth either 1% or 1.1%. So if you work for a year, you get 1% of your high 3 for the rest of your life. If you work 1 month of a year, you get 1/12 of 1% of your high three for the rest of your life. So, which is more valuable? 1/12 of 1% of your high three or 1/12 of the COLA? And the answer, obviously, it depends on how high the COLA is. But in order for the COLA to be as valuable as 1/12 of 1% of your high three, the COLA will have to be about 9%. Inflation will have to start raging at 9%, which, by the way, inflation these days, I'm sure you guys are aware, is relatively high, but it's not yet 9%. They're not giving 9% COLAs out. So if the COLA was 9%, then it might be worth it to retire at the end of November just to get the 1/12 of the 9% added to your pension. But if it's not going to be that high, then you're going to be better off pushing it to the end of December, which case you get paid for the month of December, as well as you get the month of December added to your pension. So the first argument I gave you was the weakest argument, the jumpstart on the COLAs. However, the next argument I'm going to give you is actually very strong, so strong that it might make my first weak argument look good. So let's talk about the second argument, okay? The second argument has to do with your annual leave payout. For those who retire, if you have a balance of annual leave, that annual leave will be paid out to you lump sum. Now, the question is, how does that annual leave get taxed? Do you pay federal tax on the annual leave? Yes, you do. Yes, you do. Do you pay state tax on the annual leave? Yes, you do. It depends on which state you live in, but if you live in a state that has income tax, yes, you do. Yes, you do. Do you pay Social Security tax on that annual leave payout? And the answer is yes, unless your income is above the Social Security cap. I don't know if you guys know what I'm talking about. Social Security doesn't tax all of your income. They only tax the first $147,000 or whatever the number may be, $147,000 of your income. If you have income beyond 147, you will not owe Social Security tax on that annual leave. Wow. Or on any income that you make beyond 147. Some of you guys know exactly what I'm talking about, because come October, November, December time, your take-home pay goes up and you find extra money in your paycheck. And when you discover that extra money, you're like, ooh, extra money. Where did that come from? You know exactly where it came from. It came from the fact that they stopped taxing you for Social Security after your income reached that max, the cap of 147,000. So any income that you make beyond 147, you avoid Social Security tax, and that's 6.2%. That is 6.2%. Now let's think about this. If you get that annual leave payout, will it be subject to the 6.2% Social Security? And the answer is, it's not going to be subject to 6.2 Social Security if your income has already hit the 147 cap. Now pay close attention here, because the details make a difference. If a person retires December 31st, will they get the annual leave payout that very same day that they retired? Nope. Nope, that's not the way it works. The way it works is your annual leave, the lump sum annual leave, gets paid out to you the pay period after you separate. So if you separate at the end of December, you're not going to receive that annual leave payout until a couple weeks later in January. And if you receive the annual leave payout in January, it's going to be subject to the 6.2 Social Security taxation, because your income starting in January goes back to zero, and now you have not yet reached the cap of 147,000. So any income that you make in January is going to be subject to the 6.2 Social Security taxation. So retiring December 31st is not going to allow you to avoid the 6.2 taxation on the annual leave. You really have to retire early enough in December so that you receive the annual leave before the end of December. So let's give an example. Let's say a person retires December 1st. If you retire December 1st, will you receive the annual leave before December 31st? Yeah, Yeah, most likely you'll receive the annual leave before December 31st. But can anybody remember, why don't I want to retire December 1st? Because as I said before, if you work even one day of a given month, you are not deemed retired for that month, and you lose the pension check for that month. So you don't want to retire December 1st. You actually want to back up to November 30th. If you retire November 30th, then you'll receive the annual leave before the end of the year, and you will avoid the 6.2 Social Security taxation on that annual leave. Not only will you avoid the 6.2 Social Security taxation on annual leave, but since you retired November 30th, you're going to get the jump start on the COLAs. Remember, the jump start on the COLAs by itself is not justifiable. It doesn't make sense. But once you couple that with the 6.2 tax savings on that annual leave payout, some of you are going to have a substantial annual leave payout. And if you're avoiding 6.2, that could translate to some real good money. So those were a couple of arguments to retire towards the end of the year. Let me give you a couple of arguments to retire towards the beginning of the next year. I think the first argument to retire at the beginning of the year, I think that's one most of you intuitively thought of on your own. When you receive the annual leave payout, would you like to receive it at the end of a year that you worked the entire year and your income was relatively high? Or would you rather receive it at the beginning of the next year when you're not working, you're retired, and your income is going to be substantially lower? Which one would you rather receive it at? I think most of us would intuitively say it's better to receive it at the beginning of the next year when my income is going to be lower. This way I'll be in a lower tax bracket. If I would collect the annual leave at the end of the year, after a year's worth of making my full salary, I'm going to be in a higher tax bracket. So intuitively, many of us recognize that pushing the annual leave into the next year may have the annual leave taxed at a lower tax bracket. Now, I understand that assumption that you'd be in a lower tax bracket. And let me just first say a couple of things. Number one, you might not be in a lower tax bracket. I know in retirement, your income is going to go down, but it has to go down enough to push you into a tax bracket lower. So pay close attention. Just because you're making less income doesn't automatically push you into a lower tax bracket. That's one thing to consider. But there's something else to consider as well. What tax bracket are you in now versus what tax bracket will you be in when you retire? Most of you on this call right now are in the 24% tax bracket. I know some of you are in the 32%, and we'll talk about those in just a second. But most of you are in the 24% tax bracket. When you retire, assuming that your income drops you into a lower bracket, the lower bracket is going to be the 22 bracket. So basically, you're going to go down from the 24 down to the 22. Can anybody do the math for me? What is the tax difference between 24 and 22? That's 2% tax savings. Now, 2% tax savings, it's wonderful. I'm all for 2% tax savings. But you got to ask yourself, what's more valuable? The 2% tax savings for retiring at the beginning of the next year, or the 6.2 Social Security tax savings if you retire November 30th of the previous year? Obviously, 6.2 is going to be more valuable than 2%. Now, let me turn my attention to those who are in the 32 bracket. If you are in the 32 bracket right now, when you retire, your income is going to drop you down probably into the 24 bracket. So right now you're in 32, you're going to drop into the 24. What's the tax difference between 32 and 24? 8%. Aha. So that makes it interesting, because if you push your annual leave into the next year, you will save 8%. As opposed to collecting the annual leave at the end of this year, which helps you avoid 6.2 Social Security, But 6.2 Social Security is not as valuable as the 8% annual leave, 8% federal tax on the annual leave. So believe it or not, it depends which bracket you're in, if you're going from 32 down to 24 or going from 24 down to 22. If you're going from 32 down to 24, it actually makes sense to push the annual leave into the next year. However, if you're going from 24 down to 22, then it's not as valuable to push it off into the next year. It's actually more valuable to take it before the end of this year and avoid the 6.2 Social Security tax savings or tax liability. That was my first argument to retire at the beginning of the year. There's another argument to retire at the beginning of the year, and that is the free money. The free money. I know some of your ears are perking up. Did he say free? Did he say free? Where? Where's the free money? You heard me. You heard me correct. You heard me correctly. One of your benefits is giving away free money. And I'm not even talking about the TSB match. I'm not even talking about that. Does anybody know where can we find the free money? Which benefit is giving away free money? And the answer is your FSA, your flexible spending accounts. They give away free money. Now let's explain. How does that work, free money? I don't remember the FSA giving away free money. Well, here's how it works. It's specifically with the healthcare FSA or the Lex FSA. For those who don't know what Lex FSA is, you should definitely listen to one of the other recordings about FSA, Lex FSA, HSA. I think that's going to be worth your while, okay? But what I'm about to say applies to the healthcare FSA and the Lex FSA. It does not apply to the dependent care FSA. So on the healthcare FSA and on the Lex FSA, the way the FSAs work is they will reimburse you money that you have not yet put into your FSA account. What do I mean? Let's explain. If you sign up for FSA during open season, November, December, you sign up for FSA, and you decide you're going to contribute the maximum, $2,850. Please tell me, how does FSA take the $2,850 from you? Do they take $2,850 all in one paycheck? Or do they gradually take it from you over the 26 pay periods of the year? And the answer is they take it gradually. Every pay period, they take slowly but surely 1/26th of the amount that you contribute to your FSA. However, if you run up a medical expense at the very beginning of the year, and that medical expense is at least $2,850, you could submit to have the entire $2,850 reimbursed to you, and they will reimburse you the entire amount, $2,850, even though you have not yet put in $2,850 of your own money. Essentially, FSA will front you the $2,850. They're going to front you the money, which sounds very risky. Why in the world would they front you the money? And the answer is because they know you're good for it. You're going to be on the payrolls over the next 26 pay periods. So slowly but surely, they'll get back the money that they fronted you. But one second, there's a major assumption there. Who says I'm going to be on the payrolls for the next 26 pay periods? Why wouldn't I be? Well, because maybe I'm going to retire. And if I retire after they have already fronted me the $2,850, will I be responsible to pay that money back once I retire? And the answer is no, you will not. Oh, man. It seems so wrong, doesn't it? I used to feel guilty telling people about this trick until I saw it plastered on the FSA website. The FSA says clearly on their website, you will not be responsible for paying back the money that they fronted you. So if you hear what I'm saying, essentially what you could do is you could schedule all your medical stuff at the very beginning of the year. Your doctor's appointments, your dentist appointments, your LASIK surgery, whatever it is you want to schedule all at the very beginning of the year. Run up a bill for $2,850. FSA will reimburse you the entire $2,850, even though you have not yet put in that money into the FSA. And then you could retire. And as you're leaving your building, you could turn around and wave a thank you to all those use it or lose it people who sponsored your LASIK surgery. It was very nice of them. So generous. I know, it seems terrible, doesn't it? Okay, so those are a couple of arguments as far as timing in the year, end of the year, beginning of the year. Let me throw another argument on the table. It's not relevant for everybody, but it could be relevant for a bunch of you. Performance bonuses. Some of you get your performance bonuses in October, November time. However, some of you don't get your performance bonuses until January. So if you're expecting a large performance bonus, you want to make sure you're still in pay status when that bonus is getting paid. So that may change your plans. If you're getting paid your bonus in January, you might have to stick around until that bonus is actually paid out to you. So keep that in mind, those performance bonuses. Okay, so on to the next thought. We just spoke about which time of the year. Should it be the end of the year? Should it be at the beginning of the year? Now let's get a little bit more focused. Which time of the month? Which time of the month should a person retire? Well, here's the rule you need to know. That your pension starts the month after you're deemed retired. The key word in that sentence being deemed retired. And who does the deeming? Do you deem yourself retired? Well, very nice what you deem yourself. But I have news for you. You have to meet OPM's definition of deemed retired. And here are OPM's definitions of deemed retired. They actually have a different definition, whether you're a FERS person or a CSRS person. Let's start with the FERS person. In order to be deemed retired, if you are a FERS person, you cannot work even a single day of a given month. Because if you work even one day of a given month, you are not deemed retired that month. So let's give an example. A person who wants to retire December 1st. December 1st. So that's their final day at work. They come to the office, and let me ask you guys, between you and me, how much work gets done on that very last day? What, do they have to turn in their badge and their laptop? And then they have their goodbye parties, right? So they have some food, people say some nice words, they give you goodbye gifts. So on December 1st, when you're not doing any work, but you're still considered an official federal employee, if that's your last day, if that's your date of final separation, the date that you put on your retirement application, you're still considered a federal employee on that day. And then December 2nd, you could be off to Tahiti, taking a major vacation and sending a postcard to the people in your office. Now, ask the people in your office, does that person look retired? And they'll say, oh yeah, that person's definitely retired. Ask OPM, however, if that person is retired. And they're going to say, wait a second, weren't they still employed on the first day of that month? December 1st or whatever month it would have been? Yes, they were still employed on that first day. Well, guess what? That means you're not deemed retired for the month of December. Instead, this person will be deemed retired the next month, the month of January. And their pension starts the month after that, which means their pension starts in the month of February. Now, this is where it gets costly. When that pension check comes at the beginning of February, how many months of retirement are included in that first pension check? And the answer is the first pension check that you get at the beginning of February will only include 1 month of retirement in it, the month of January. What happened to the month of December? Well, remember, December, you weren't deemed retired in December. So therefore, you're not going to get any retirement pay for December. But during December, you were also not working. So there's no work compensation that you've earned in December. So it turns out in December, you're not working and you're not retired. You're in no man's land. No man's land for the entire month of December. You just lost a month of your pension. Now, some of your pension checks, your monthly pension checks, could be $3,000, $4,000, $5,000 a month. So you just walked away from that by retiring at the beginning of the month. For a first person, in order to avoid or in order to minimize no man's land, a first person should aim to retire as close to the end of the month as possible. You could take it the very last day, January 31st or January 30th even, okay? As close to the end of the month as possible. That's if you're a first person. CSRS person. The rules are slightly different for CSRS. CSRS, they will allow you to work the first, second, and third and still be deemed retired that month. You just cannot be working the fourth day to the end of that month. If you work from the fourth day of the month to the end of the month, you're not deemed retired that month. So let's go back to my example. Somebody who retires December 1st. If you're a first person and your date of final separation is December 1st, you're not deemed retired in December. But if you are a CSRS person and your date of final separation is December 1st, you will be deemed retired for the month of December. So CSRS, you should retire either as close to the end of the month as possible or on the first, second, third day of the next month. By the way, CSRS people, if you remember my whole idea of the jumpstart of the COLAs, how I was telling people that they should possibly consider November 30th, that's because they were in FERS. They don't want to work December 1st, 2nd, and 3rd. They'll be in no man's land in December. That's not worth it for them. But a CSRS person, if you retire 1st, 2nd, or 3rd of December, you will get the pension check in January. And there will already be that prorated COLA in that first pension check in January. So the rules are slightly different for CSRS versus FERS. Fantastic. So that is time of the month. Now let's go a little bit further over here. What about in the pay period? Which specific time within a pay period? So we already figured out the age. We already figured out the time of the year. We already figured out which month and the time of the month. Now, when in the pay period? Is it okay if I retire in the middle of the pay period? Should I aim to retire at the end of the pay period? Does it even make a difference? Well, it makes a slight difference, actually. Leave accrual only happens at the end of a pay period. What that means is if you retire in the middle of a pay period, you'll get paid, but you won't accrue any of the leave for that pay period. In order to accrue the leave, you have to have worked until the end of the pay period. Okay? And so the pay periods usually end on Saturday. So if you stop working on Friday, you want to have your date of separation, the date of final separation, on Saturday. Even though you stop working on Friday, but your date of final separation, Saturday. This way, you retired at the end of the pay period and accrued the extra leave for that pay period. Now, I'm sure you guys are noticing that when you're choosing your retirement date, a lot of stars have to align perfectly. There are a lot of details that go into it. Of all the considerations, of all the stars that need to align perfectly, this one of retiring at the end of the pay period is really the least significant. It's not a big deal. If you retire at the beginning or the middle of a pay period, so what are you walking away from? The couple of hours of leave that you would have accrued? Again, who am I to spend your money? But don't drive yourself bananas to make sure that you retire specifically at a date that's the end of the pay period. I'd be more concerned to retire at the end of the month than at the end of the pay period. Okay, let's go a little bit further. When it comes to leave, by the way, there's a couple of types of leave. There's sick leave and there's annual leave. Do you guys know what happens to the unused sick leave and the unused annual leave? So the unused sick leave, that gets added to your total service. It counts towards your pension. The annual leave does not count towards your pension. It gets paid out to you lump sum. Now, I want you guys to think about this. What's better? Is it better to retire with the biggest balance of leave possible? Or is it better to spend down your leave as much as possible? Let me say the question again. I'm asking this question regarding both sick leave and annual leave. Is it better to retire with the biggest balance of leave as possible? Or is it better to spend down the leave as much as possible? Well, let me give you a couple of illustrations that might highlight ways you could utilize your leave when you retire. So this is already a few years ago this event happened. I was one of my clients, they were retiring, they had a medical condition, and they had to have a surgery. So they were planning on retiring. Let's just give a date. I don't remember the dates, but let's say it was the end of June. They were going to retire at the end of June. And then at the beginning of July, they were going to have a surgery, and the surgery was going to sideline them for the entire month of July. So their plan was retire at the end of June, have surgery at the beginning of July, and be sidelined for the first month of their retirement in July. That was their strategy. I proposed an alternate strategy. I said, you know what? Instead of retiring at the end of June, why don't you just use your sick leave? You know, have that surgery at the beginning of July. You'll be sidelined in the entire month of July, but instead of you being sidelined in retirement, you'll be sidelined and spending down your sick leave because you're still employed. How does this help them? How does that strategy help? Well, if you investigate it, you'll actually see there are at least five benefits that I could count with doing that strategy. What are the five benefits that you could get by utilizing that strategy? Well, let's think about this. Because you spent down your sick leave in the month of July, wasn't July now added to your pension? Now, the truth is, even if you didn't spend on a sick leave, the sick leave time would have been added to your pension also. So the truth is, either way, that amount of time would have been added to your pension. However, there's another benefit. You got paid for your sick leave. While you were spending down your sick leave in the month of July, not only was July being added to your pension because of your sick leave, but you got paid for that sick leave. And by the way, while you're on leave, you were accruing more leave. Oh, and if you're a FERS employee, while you're on leave, you're still getting TSB matching from your agency. And while you're still employed, there's a few other crumbs I could sweep in here. While you're still employed, your FEHB premiums are pre-tax. I don't know if you guys know this. While you're working, your FEHB premiums are pre-tax. Once you retire, your FEHB premiums are no longer pre-tax. They're no longer going to reduce your tax liability. So it turns out by you extending your stay at work with that sick leave, you got pre-tax FEHB premiums for another month or so. And that's not big bucks, but nonetheless, it's an additional benefit. So it turns out that by this gentleman using my strategy, instead of getting one benefit for his sick leave, which would be the time added to his pension, he got 5 benefits for his sick leave. Time added to pension, got paid for his sick leave, accrued more leave while on leave, TSB matching, pre-tax FEHB premiums. Now, that case is an unusual case. It's not usual that a person has such a sick excuse. You need to have a legitimate sick excuse for you to take off so much with sick leave. You can't just be sick of work. Can you? Okay, so let's just say sick leave is not going to be an option for most of us. However, we could use the same thinking with annual leave. Let's give the same example. Somebody's retired at the end of June. And then at the beginning of July, they're going to take a vacation. That's what their plan was. I'm going to propose an alternative. Instead of retiring at the end of June and then going on vacation in retirement, why don't you just go on vacation, spending your annual leave. And then at the end of July, that's when you'll retire. Once again, are you noticing the 5 benefits that this person will receive? Number 1, July got added to their pension. Number 2, they got paid for their annual leave. Now, you anyhow we're going to get paid for your annual leave. I'm just adding it to the total of the 5 benefits. Number 1, you got July added to your pension. Number 2, you got paid for your annual leave. Number 3, you accrued more leave. Number 4, TSP matching. Number 5, pre-tax FEHB premiums. Wow. If you follow me, in both examples I gave you, all I did is I found somebody who was planning on retiring at a certain date, and I said to them, instead of retiring on that date, why don't you just act retired that date? Pretend you're retired. Just pretend and spend down your leave. Now, the truth is, spending down your leave and riding off into the sunset on your leave, that's technically a no-no. Technically a no-no. It's called terminal leave. And technically, it should be frowned upon and it shouldn't be done. However, make no mistake about it. Plenty of people are doing this. It's happening all the time. And what you could do is you could schedule a major vacation and then you could come back for the last day to turn in your badge. This way you don't ride off into the sunset on your leave. You came back, you did an extra day of work, or if it's 2 days of work, whatever the number may be. You really have to feel out the dynamic in your office. Okay, what's the dynamic between in the office? What's your relationship with your boss like? But let's not be naive. There are people doing this all the time. Okay, now when it comes to annual leave, I'm sure you guys are aware that there's a use it or lose it date. That means if you go beyond the leave year ending date. So for example, 2022, the leave year ends on December 31st, which by the way, that's very unusual, as you can see. Most other leave years do not end at the very last day of the year. Most of the leave years, they end into January. But if anybody here wants to retire with the maximum amount of leave, maximum amount of annual leave, they'd have to carry that leave to the very last day of the very last pay period. So basically, if you retire December 31st, 2022, then you retire with the maximum amount of annual leave. By the way, does anybody here know what the maximum amount is? So for most employees, you have the 240 carryover. And then over the course of the year, you could accrue another 208. So 240 plus 208 equals 448 hours. For most people, the maximum is going to be 448. If you're a senior executive, you can start off with the 720. If you have foreign service, you can start off with the 360, right? But for most people, it's going to be the 240 carryover plus the 208. So the maximum is 448. If you go beyond the leave year ending date, then any amount over the 240 carryover is washed away, use or lose. Unless you have restored leave, which many have restored leave this past couple of years because of COVID. The government has been very lenient with the restored leave. So there are some people who are retiring beyond with more hours than the carryover, even though they're retiring, towards the beginning of the year. But if you want to retire at the maximum amount, you retire towards the end of the year, and then you have the maximum amount. But again, don't drive yourself bananas. In fact, what I'm suggesting is you get 5 benefits by spending down that leave. So don't worry about retiring with the maximum amount. Okay, fine. Let's go a little bit further. Now, we spoke about when in the year, when in the month, when in the pay period. Now we're going to get to a final point, which is very case specific. Very case specific. Your pension is based upon years and months, not days. Any days that you have are going to go into the trash can. Now, I warn all of you, everybody here is going to have some denomination of days that goes into the trash. Everyone. It's just, that's what's normal. The question is, what denomination going into the trash bothers you? What do I mean? I'm sure you guys realize that if you have enough days, the days eventually will add up and convert into a month. Does anybody here know how many days are there in a month? I know what you're thinking. You're thinking it depends which month, right? Because like in February, there's 28 days, or in January, there's 31 days. So actually, in the eyes of OPM, there's only 30 days in a month. We don't care which month. There's only 30 days in a month. So imagine this. Imagine a person retires and they have 29 days going into the trash. In fact, I'm going to flip to the next slide so you can see an illustration of exactly that. So let's go to example number 2. Somebody's retired July 18th, 2035, and their date of final separation is July 18th, 2035, and their service comp date is August 20th, 1995. So if you tally up this person's total service, again, I'm on this slide looking at example number 2. If you tally up this person's total service, you will see their total service is 39 years, 10 months, and 29 days. You know what that means? Their pension is going to reflect 39 years, 10 months. But what happens to the 29 days? Trash. Now, I asked you, if you have 29 days going to the trash, would that bother you? Would that bother you? You have 29 days going to the trash can. Would that bother you? What do you need to do to convert the 29 days into 30 and get credit for the month? What's needed? If you think about it, all you need to do is work one more day. Do you hate your job that much? You can't even work one extra day? Now, the truth is, sometimes working one extra day opens up another can of worms. Can anybody spot it? Can anybody spot it? What would be the situation where working one more day would open up a whole other can of worms? So if you remember, if you're a first employee and you work even one day of a given month, you're not deemed retired for that month. You're in no man's land for that entire month. You lost the value of the pension for that month, a few $1,000s. So imagine you scheduled your retirement at the end of a month, only to discover that you have 29 days going into the trash can. And you're thinking to yourself, oh no, maybe I should work one more day. If I work one more day, I'll get 30 days and it'll convert into the month, and then the month will be credited to my pension. But if I work one more day, it's going to be the first day of the next month, perhaps, again, in your situation, it could be the first day of the next month, and then I'll be in no man's land. Now I have to decide what's more valuable. Is it more valuable to work the one extra day, get the 30 days converted into a month, and have that month added to my total pension? Or should I just let the 29 days go into the trash, because by working one more day, I'll be in no man's land, and I'd rather avoid no man's land than get the 30 days added to my pension? Does anybody here know which one's more valuable? To have the 29 days convert into 30 and get that added to your pension, or to avoid no man's land? The answer is avoiding no man's land is much more important. Why? Because if you get 30 days added to your pension, so that's a month added to your pension, what's the value of a month? Remember, for every year you work, it's worth 1% of your high 3. So 1 month is worth 1/12 of 1% of your high 3. If your high 3, let's say, is $150,000, 1% of $150,000 is $1,500. Divide that by 12, and that's, what does that equal to? $120 a year. Is it worth it to work that one extra day to get $120 a year at the expense of being in no man's land and losing about a $3,000 pension check? It's not going to be worth it for you. Not going to be worth it. My point over here is as follows. If you have 29 days going to the trash, that might bother you. What about 28 days? What about 27 days? How low can you go? At some point, you're just going to say, you know what? Keep your days. I don't need your days anyhow. But everybody here, when you're scheduling your retirement day, you know when in the year, you know what age, you know when in the year, you know when in the month, you know when in the pay period. But then there's something that's very specific to you, which is how many days are you going to get credited towards your pension, or how many days are you going to let go into the trash can? By the way, for those who are following my illustration on this board, you'll notice in this illustration, I did not include sick leave. On this next slide, however, I will show you that sick leave could help you get from the 29 days over into 30. Okay, so I'm just giving you from someone's estimate. I just copied it just for illustrative purposes. Okay, this person has a whole bunch of service. They have many years of service, 27 plus 11 months, and so on and so forth. Okay. However, then they also have 21 days of sick leave. I'm not sure if you guys can see that gray line, the line that says sick leave. So the sick leave of 21 days gets added to the total tally. So when you add it all up, this person ends with 6 extra days. Why only 6 extra days? Because the sick leave brought them over the 30 by an amount of 6. So let's go back to my previous slide. In example number 1, when the person has 25 years, 4 months, and 11 days, those 11 days will go into the trash. But if a person has 19 days of sick leave, the 19 days of sick leave will combine with the 11 days, and then that will equal a month. And so the month gets added to the total month column. So this person will have 25 years and 5 months if they had 19 days. If they had 18 days, then they'd have 11 days plus 18 equals 29. It goes into the trash. In example number 2 on the slide, 39 years, 10 months, 29 days. All this person needs is 1 day of sick leave. If they have 1 day of sick leave, it gets added to the days, and the days convert to a month, and the month get added to your pension. So the amount of days that you have left over, the amount of days that goes into the trash can is very specific to you. Very specific to you. Now, everything I've shared with you, technical stuff. We spoke about when in the year, when in the month, when in the pay period, how many days are left over. We spoke about all the details, and all these details are absolutely critical. But when you're trying to pinpoint the best time to retire, in addition to all the details we shared, there is one more critical consideration for choosing the best time to retire. And that one additional consideration is you better be ready for it. Does anybody here know the number 1 cause of depression in the United States of America? Right? It's not retirement, even though the way I framed the question, it made it seem like it was retirement, okay? But the number 1 cause of depression is not feeling productive. Not feeling productive. When people feel that they're not being productive, they're not contributing, they're not doing anything productive, then it depresses them. Very depressing. So I want you guys to think about that. Because as much as we love to kvetch and complain about our jobs, we have to recognize that there are many non-financial benefits that we get from working. Non-financial. There are many of them. Can anybody here think of any non-financial benefits to working? I know it's hard, right? It's really hard to think about it. But if you put your mind to it, I'm sure you can think of some of the non-financial benefits. I'll give you 4 of them. 4 non-financial benefits. Number 1, social interaction. At work, you have a healthy dose of social interaction. You're interacting with people all day long. You've been doing that your entire life. And then all of a sudden, you retire. Once you retire, where are you going to get your social interaction from? Oh, I know. You know where you're going to get your social interaction from? Your spouse. Of course. How can I forget? Now, when it comes to spending time with spouse, I know some people are looking forward to retirement, to spending quality time with their spouse. I get that. And then there are others that feel too much time with spouse could be counterproductive. So be very, very careful over there. Where are you going to get your social interaction from? That's one non-financial benefit. Number two, intellectual stimulation. At work, you're using your noodle. You're making decisions and distinctions. You're articulating your thoughts, whether it's in written format or in oral format. You're staying sharp. You're staying with it. And then you decide, I'm going to retire. Let somebody else use their noodle. Really? Have you ever met somebody that as they got older, they became a little dull? You know what I'm talking about? They lost their touch a little bit because they weren't using their noodle. What are you going to do to stay sharp and stay with it once you retire? TV all day is not going to help. A third non-financial benefit is that sense of productivity. I'm being productive. I'm doing something. I'm making a contribution. When you retire, where are you going to get that? I know some people, when they leave their jobs, their self-definition came crumbling down. Now, I'm not saying that's the right way it should be, but nonetheless, we have to recognize that many people want to feel that they're doing something, that they're needed in the world. Once you feel that nobody even needs you, you're not doing anything, it hurts emotionally and it drives people down. Very depressing. And another non-financial benefit we get from working, daily structure. You pretty much know the structure of your days. You've been doing this for so many years now. In retirement, you have to create the structure of your day. And you're going to have to do so for decades and decades of retirement. So, I want you guys to think about that strongly. Imagine a person retires. They have plenty of money. They can easily afford it. But once they retire, they have no social interaction, no intellectual stimulation, no sense of productivity, no daily structure. Wow. Would you guys call that a successful retirement? I wouldn't. So this is important. These retirement date decisions. Some of them are very technical and have to do with maximizing federal benefits. But then the broadest retirement decision is not so technical. It's really more just personal and introspective. Why do you even want to retire? I know everybody else is doing it. So what? Why is that a goal of yours? And what are you going to do for social interaction, intellectual stimulation, sense of productivity, daily structure? I want you guys to be successful in retirement, not just financially successful, but also fulfilling your personal goals as well. Okay, very, very good. Now, I want to open the floor to questions. But before I take questions, let me just make my announcement that I did before, that you guys should not walk away from any federal benefits. As you saw this class, we were getting into technical details, how it actually can make a difference. If you work one extra day, you're in no man's land, you lose thousands of dollars. One extra day could cost you thousands of dollars. You don't want to walk away from any of that. So I encourage you guys to discuss your benefits. If anybody here wants to take me up on my offer, I offer a complimentary consultation. It's right there in the sidebar. You guys see that picture, that green button that says learn more? Click that button and request your complimentary consultation. I'm happy to get together with you and we could talk about your retirement dates and your retirement decisions in general. I'm happy to help you maximize your federal benefits and maximize the rest of your financial life as well. So please, please, please click that button right now and request your one-on-one consult. I'm going to turn the floor over to some questions. Let's see what we have over here. I know we have some people with questions over here. Let me see in the chat box. Okay, so we have some questions in the chat box. So James has, what about the increase in Social Security payments you get from retiring in January? So James, are you talking about the same consideration as far as the COLA increase that kicks in January? Is that what you're referring to? Because that I didn't mention for Social Security, but the same idea that applies to your federal pension also applies for Social Security. You're also going to get a COLA in Social Security as well. So depending upon when you retire, that influences the amount of Social Security you get. Okay, let's give another question. I see that, let me see, I see that Bob asked the question. If adding in sick leave brings your service to February 28th, that counts as a month? Bob, no, it's not so much that it brings your service to February 28th. It has to bring your total service to 30 days. 30 days equals the month. So Bob, in your situation, we have to take your date of final separation minus your service comp date, and that gives you a total service, years, months, days. Let's say you have X amount of years, X amount of months, and 5 days. So those 5 days are going to go into the trash can. Then, Bob, if you have another 25 days of sick leave, the 25 days of sick leave get added to the 5 days of service. 25 plus 5 equals 30. That 30 gets converted to a month, and voila, you get credit over there. Karen is asking a question. Does anybody know how long it takes OPM to process retirement applications? Ooh, Karen, great question. I have news for you. In general, OPM's turnaround time, at least this is what they strive for. They strive to have a turnaround time of about 2 months. However, they always seem to be backlogged, always. And so typical turnaround time is 3 months. Oh, and by the way, that's assuming it's relatively easy for them to process and adjudicate your pension claim. But if you have complexity in your federal career, so for example, if you were jumping from agency to agency to agency, or if you owe a deposit or a redeposit, or if you converted military time to civilian time, or if you converted from one retirement system to another retirement system, anything that requires OPM to think, thinking takes time. It does. And that's when you'll hear the horror stories of some people who their adjudication took 6 months or 12 months or 18 months. Now, during that time, they were probably receiving interim checks. But the interim checks, FYI, are somewhere between 50% and 80% of the full pension amount. Those are not my words. Those are OPM words. So you want them to adjudicate as quickly as possible, but sometimes it takes them their sweet time, and it could be costly. I see another question. Doug has a question. If I delay my retirement until next January instead of December 31st, will the possible 4.7 increase? Doug, when you say a 4.7 increase, which 4.7 are you talking about? This past year, it was a 5.9 increase. Next year's COLA has not yet been announced. Okay, are you talking about a 4.7 in your employment pay? The 4.7 employment pay that you'll get with your annual leave payout. Your annual leave payout will reflect that increase in your pay. Okay, so James has a question. Not the COLA, the increase from working another year under Social Security comes in January. So yeah, James, yeah, you don't have to work a full year, by the way, James. I just want to make sure we're clear about this. You don't have to work a full year for Social Security. You can work partial years and get partial increases. Okay, so every month that you work, that's going to increase your Social Security benefits. Okay, and you could request, your Social Security in advance. I guess what you're trying to ask is, if I retire in January, they won't necessarily know how many months of the previous year I was working because I've yet to file my taxes, so they don't know. And I think Bob is asking the same question. What about Social Security COLA that is in January? So if you're receiving a Social Security benefit in January, so long as you were considered retired in the previous year, you should already receive your COLA in that next year. But as far as how many months of the previous year were you working, and Social Security won't even know that until later on in the year, that's a great question. I don't know the answer to that question. At some point when you file your taxes, Social Security will be aware of how many months worth. The truth is, now that I think about it, I think the answer is obvious. I think the answer is obvious. The answer is when you collect Social Security. I'm not even sure why I'm getting tangled up with it. The answer is pretty straightforward. It's when you collect Social Security. So if you worked until November of the previous year, but didn't collect Social Security until January, then that's your Social Security benefit will give you credit as if you delayed Social Security until January. I'm not sure why I even got my wires tangled in it. I think it's a pretty straight question. Maybe if I'm not answering your question, James, you could clarify for me. Tom says, no, I won't get next year's pay raise unless I work next year, prorated. Tom, no, the way the annual leave payout works. So Tom, just to clarify, the way the annual leave payout works is it gets paid into the future. It gets projected into the future. So if you retire December 31st, and let's say when you retire, you have an entire month of annual leave. And we know that there's a pay increase scheduled to happen on the 7th of January. So what's going to happen is if you have an entire month of annual leave, however many of those annual leave hours that take you up to the 7th of January, that will be paid at your current pay level. And then any hours that extend beyond January 7th, that will be paid at the increased level. So I hope I'm answering your question, Tom. I'm not 100% sure if I'm answering accurately, but you're right, Tom. The high fee is a different calculation. Pamela is saying, I am planning to use my annual leave up to 2025, then retire at the end of the year when my birthday is the 25th of December. I plan to retire at the end of 2025, or should I wait to the end of January 2026? So Pamela, I think I need to know a little bit more about you. First of all, I need to know the size of the annual leave check. I want to know what's going on over there. If I'm hearing you correctly, Pam, then even if you retire at the end of December, you're not going to get the annual leave at the end of the year. It's going to go into the next year, if I'm hearing you correctly. So if that's true, Pam, then you're probably better off to retire either the end of December or the end of January. I don't think it makes a difference as far as you're not going to do the end of November. It's either going to be the end of December or the end of January. And the difference is going to be minimal over there. I wouldn't worry about it. The only other thing I look for, Pam, is whether you have TRICARE. That makes a little bit of a difference, but I'm not going to get into that right now. Michael Holmes, I was told by OPM this week that they require you to formally request the synopsis of your interim payment breakdown. They won't send it automatically. My payment from September to December has never been adjudicated to date, and I have been calling over and over to get breakdown. This appearing to be something new. Wow, Michael, that is news. That's news to me. Now, just because it's news to me doesn't mean that it's brand new. It could be that I just was I'm not as educated. So, Michael, I'm glad you're sharing that with me. I guess I'll pay attention to see if that's happening to more and more people. Okay, one more question, or actually two more questions, and then we're going to go. Two more questions. Question from a private question. So I might even say the person's name and name. If I retire on November 30th, I'm not sure whether this is private. If I retire November 30, but have unused annual leave, will that alter my end date since I won't get paid out for it until the next pay period? So no, if you retire November 30th and you have unused annual leave, that will not alter the end date. Okay, so that's a good question. Good to clarify that, but that's not going to change anything. Brian, last question. Brian is saying, do you have to spend FSA money before retiring to get the free money? Brian, no, but you have to accrue the expense before you retire. So, for example, you can make a claim after you retire, but the expense needs to be accrued before you retire. So let's say, for example, you run up an expense in January, and then you retire at the end of January, and you submit the answer, and you submit the reimbursement afterwards. That's fine. That's fine. Okay, just make sure that you submit it. Just make sure that you incur the expense before you separate. Okay, fantastic. I know I went overboard, guys. I'm sorry to keep you late. It's already 8 minutes past for some people that have to hop off. And I'm very grateful for those who attended this class. And as I mentioned, I'd love to connect with you guys and speak with you one-on-one. That offer, the complimentary consultation, that offer still stands. So anybody here who sees that blue button on the right side or that green button on the right side that says learn more, click there right now, request your one-on-one consult, and I'd be happy to talk with you one-on-one about your personal retirement date decisions as well as the larger financial planning picture with you. I wish you much blessing and success. All the best, everybody. All the best. All the best, everybody. I'm logging off.